In the book Common Stocks and Uncommon Profits, Philip Fisher described what he calls the scuttlebutt method for finding investments. This method was the process of discovering as much about a company and its products as possible. He developed a 15-point checklist to check if the company has growth potential and is a worthwhile investment. Hi, welcome to The Holder Investor, and in this video, we will go over the top 5 lessons from the book Common Stocks and Uncommon Profits by Philip Fisher. First, the scuttlebutt method. The scuttlebutt method consists in learning about a company and its investment merits by making intelligent questions for people involved in the business. You can talk to competitors, providers, sellers, clients, executives, employees, and former employees. Common Stocks and Uncommon Profits were published in 1958. Nowadays, with the internet, it is easier to apply this method. I will share with you the new ways of applying the scuttlebutt method. Watch executive interviews on YouTube to learn about the company strategy. Listen to conference calls, where investors and analysts make questions for the company about the results, strategy, and future projects. Use LinkedIn to ask questions to the people involved in the business. Look for client opinions online on review sites or YouTube videos. For example, Tesla owner videos on how they feel about their car. Use a social network to talk with clients. Check what the employees are saying about the company on sites like Glassdoor. The 15 points checklist will help you to make the right questions, and that led us to the next point. Second, 15 points to look for in a stock. Philip Fisher says that the company must have most of the points, and if it failed to qualify on many of them, it is not a worthwhile investment. Point 1. Does the company have products or services with sufficient market potential to make possible a sizable increase in sales for at least several years? It is impossible to make a good profit from companies with a stationary or even a declining sales curve. Point 2. Does the management have a determination to continue to develop products or processes that will still further increase total sales potentials when the growth potentials of currently attractive product lines have largely been exploited? At this point, research and development begin to enter the picture. It is largely through these means that companies improve old products and develop new ones. Point 3. How effective are the company's research and development efforts in relation to its size? You can divide the research figure, R&D, by total sales and so learn the percent of each sales dollar that a company is devoting to this type of activity. You can compare this number with other companies of the same segment. Each dollar spent in R&D can become $2 or more if the company is good at research and development. Point 4. Does the company have an above-average sales organization? It is the making of a sale that is the most basic single activity of any business. Without sales, survival is impossible. It is the making of repeat sales to satisfied customers that is the first benchmark of success. Point 5. Does the company have a worthwhile profit margin? Profit margin shows if the company has competitive advantages. You should look at the historical data to see if the margin is constant or if it is growing over time. Sometimes the company can have a good margin during a period, but this margin is cyclical and will not last for long. Point 6. What is the company doing to maintain or improve profit margins? It is not the profit margins of the past, but those of the future that are important to the investor. Many companies are constantly reviewing procedures and methods to see where economies can be brought about, resulting in improved margins. Point 7. Does the company have outstanding labor and personnel relations? If workers feel that they are fairly treated by their employer, a background has been laid wherein efficient leadership can accomplish much in increasing productivity per worker. Furthermore, there is always a considerable cost in training each new worker. Those companies with an abnormal labor turnover have therefore an element of unnecessary expense avoided by better managed enterprises. Today, with the internet, we can check online what the employees are saying about the company. You can use Glassdoor, for example. That is a site where employees anonymously review companies. Point 8. Does the company have outstanding executive relations? Creating the right atmosphere among executive personnel is vital. These are the men whose judgment, ingenuity, and teamwork will in time make or break any venture. Point 9. Does the company have depth to its management? Does top management welcome and evaluate suggestions from personnel even if, at times, those suggestions carry with them adverse criticism of current management practices. Point 10. How good are the company's cost analysis and accounting controls? No company is going to continue to have outstanding success for a long period of time if it cannot break down its overall costs with sufficient accuracy and detail to show the cost of each small step in its operation. Only in this way will management know what most needs its attention. Only in this way can management judge whether it is properly solving each problem that does need its attention. Point 11. Are there other aspects of the business, somewhat peculiar to the industry involved, which will give the investor important clues as to how outstanding the company may be in relation to its competition? Here, we are looking into the competitive advantages of a company in relation to its competition, like lower expenses, better technologies, patents, and know-how. Point 12. Does the company have a short-range or long-range outlook in regard to profits? The investor wanting maximum results should favor companies with a truly long-range outlook concerning profits. Point 13. In the foreseeable future, will the growth of the company require sufficient equity financing so that the larger number of shares than outstanding will largely cancel the existing stockholders' benefit from this anticipated growth? Check if the company's cash plus further borrowing ability is sufficient to take care of the capital needed to exploit the prospects of the next several years. Point 14. Does the management talk freely to investors about its affairs when things are going well, but clam up when troubles and disappointments occur? The management that does not report as freely when things are going badly as when they are going well usually clams up in this way for one of several rather significant reasons. It may not have a problem worked out to solve the unanticipated difficulty. Point 15. Does the company have a management of unquestionable integrity? Invest in companies that the managements have a highly developed sense of trusteeship and moral responsibility to their stockholders. This is a point concerning which the scuttlebutt method can be very helpful. Third, when to buy. People usually try to time the market by macroeconomics and economic forecasts. The problem with this approach is that you probably don't have a crystal ball, and the future is unpredictable. Anything can happen. The chances of being right are not good enough to warrant such methods being used as a basis for risking the investment of savings. Investors should not try to make economic forecasts. Instead, they should focus on choosing good companies and hold them for the long. This will produce a handsome profit. Fourth, when to sell. For Fisher, there are 3 reasons to sell a stock. The first reason to sell is when a mistake has been made in the original purchase and it becomes increasingly clear that the factual background of the particular company is, by a significant margin, less favorable than originally believed. When this happens, losses, if any, should be far smaller than if the stock bought in error had been held for a long period of time. However, there is a complicating factor that makes the handling of investment mistakes more difficult. This is the ego in each of us. None of us likes to admit to ourselves that we have been wrong. Second reason, when the company no longer qualifies in regard to the 15 points checklist to about the same degree it qualified at the time of purchase. This is why investors should be constantly on their guard. It explains why it is of such importance to keep at all times in close contact with the affairs of companies whose shares are held. When companies deteriorate in this way, they usually do so for one of 2 reasons. Either there has been a deterioration of management, or the company no longer has the prospect of increasing the markets for its product in the way it formerly did. Third reason, better investment opportunities. Caution, there is always the risk that some major element in the picture has been misjudged. If this happens, the investment probably will not turn out nearly as well as anticipated. Fifth, when not to sell. The first reason not to sell is fear of a bear market. If the company is a really good one, the next bull market should see the stock making a new peak well above those so far attained. But it is almost impossible to hit when the market will down and when it will rise again. So, if you hold a good company for the long run, you do not need to worry about bear markets. Second reason, the argument that an outstanding stock has become overpriced and therefore should be sold. What is more logical than this? If a stock is overpriced, why not sell it rather than keeping it? The investor cannot pinpoint just how much per share a particular company will earn 2 years from now. He can at best judge this within such general and non-mathematical limits as about the same, up moderately, up a lot, or up tremendously. Under these circumstances, how can anyone say with even moderate precision just what is overpriced for an outstanding company with an unusually rapid growth rate? If the growth rate is so good that in another 10 years the company might well have quadrupled, is it really of such great concern whether at the moment the stock might or might not be 35% overpriced? Third reason, the stock they own has had a huge advance. Therefore, just because it has gone up, it has probably used up most of its potential. Consequently, they should sell it and buy something that hasn't gone up yet. Outstanding companies just don't function this way, as they are an excellent business, they continue to grow over time, and if you sell, you will not get the compound returns. For example, let's say you bought Amazon at $20 in 2002, and in 2013, the stock price was $393. It is a really good return, right? But if you have held the stock until today, it would value $3,335. Perhaps the thoughts behind this might be put into a single sentence. If the job has been correctly done when a stock is purchased, the time to sell it is almost never. I am starting this channel, so please, if you learned something in this video, click on the like button and subscribe to receive the next videos. Leave a comment below about which of the 15-point checklist you most liked. Thank you very much for your time. See you next time.